Market news now. Asian shares extended a global sell-off while the dollar and the treasury yields jumped as traders pared back expectations for the pace and scale of rate cuts by the Federal Reserve this year. The latest shift in rate expectations came after an upside surprise in US inflation, which showed CPI rising 3.1% on an annual basis, above forecasts for a 2.9% increase. Meanwhile, elsewhere, stocks in Hong Kong reversed early losses to trade higher after returning from the Lunar New Year holidays. Mainland Chinese financial markets remain closed for the week. To give us perspective on the markets, we are joined by Chantal Marks from F&B Wealth and Investment. Chantal, thank you so much for your time. So we've got this US CPI data that's come in higher than we actually were predicting. What was the market reaction to that 3.1%?
Well, it was extremely negative. I mean, we saw massive reactions across the globe and across risk assets. Even locally, the JSE, you could just see kind of a straight line down, the RAD, a straight line up. So a weakening bias there. I mean, even Bitcoin came under pressure as a result of that print. And I think it's just because investors really were hoping for early rate cuts. They were hoping for many rate cuts this year. And of course, easier monetary policy environment is very supportive of asset prices. And if inflation is higher than expected, then that optimism would naturally come under pressure.
What's your assessment when it comes to the overall health of the market right now?
Well, it's really difficult to say. I think that the market looks quite healthy if you look at overall market movements, particularly in the US, but it differs between geographies. So we do have some softness coming through in China. We have some softness in our local equity markets as well. And then one of the things that I'm also quite concerned about is market breadth. So in the US, you have the Magnificent Seven, or at least 6 of the Magnificent Seven, really driving that market higher. But the moves that we've seen in the rest of the US market has not been nearly as pronounced. Locally, I actually think stock market breadth has improved. So I think it actually looks a little bit better this side. So yeah, a lot of nuances and a lot of differences between geographies and asset classes.
So given this figure that we got yesterday out of the US when it comes to the CPI numbers, how much does the market then need to reprice any of its thoughts around Fed cuts for the remainder of the year?
So I think what we saw yesterday in the swap market was that the more than 50% probability of a cut was now only pushed out to July, which means that investors now do expect that the first cut to come through in July. And that is why asset prices reacted the way that it reacted. There's still a lot of investors who think that it might come a little bit earlier, but it shifted from the majority of the market thinking that rate cuts were going to come as early as March. It's now shifted out to July, which I think is more in line with what the Fed mentioned as well, both in their January meeting as well as their last meeting last year. I think the difficulty now is that you also need to start looking at the number of rate cuts being priced in. And I still think that that is probably a little bit toppish, particularly in the context of that CPI print that we saw yesterday.
What would you say are the most crowded trades right now?
Oh, it's AI. It's absolutely overcrowded. But the thing with these crowded trades is that they can really run for quite some time. I have picked up that there are a lot of retail investors that are now starting to question whether or not there's an AI bubble. And that is outside of the institutional market also pushing that narrative a little bit more now that we've also seen exceptional gains in the first 6 weeks of the year. But FOMO is an overwhelming market bias, and it's a feeling that a lot of us can't escape. So I think that for now, that trade is crowded. It still probably has a little bit of legs, but it's a dangerous place to be in, I think.
How big is the risk of resurgent inflation? And I've had a couple of analysts bring back the 1998 scenario in which easing of interest rates was short-lived as the Fed had to step back in to do something about inflation. Are you worried about that?
I think that there's an outside chance that we could see a pop up in inflation again, but I think that it will be event driven. So I think the biggest risk to inflation currently is an escalation of events in the Middle East and a real disruption to the oil supply chain. And in that case, you could actually start seeing oil prices move up, and that could derail inflation, particularly if it lasts for quite some time. I don't think that you will see a major reaction or a long-term reaction if you have a few months of elevated oil prices. But once it starts filtering through into other prices, that's where things become a little bit dangerous. So I do think that there's an outsized probability. It's not our base case right now, but I think something that we should keep an eye on.
In the lead up to the SA budget next week, what do you believe to be one risk economic-wise, or one risk to the economic outlook for you?
Yeah, I think that the budget is going to be a very difficult one. I know that there's a lot of talk that we could actually see some tax increases being proposed in this budget. Now, tax increases would be very positive for bonds because you might see an improvement in the fiscal position of the country, but it will be very negative from a consumer perspective, and that in turn will have a negative impact on GDP growth. So I'll be watching the taxes very closely. And then, of course, the other risks are on the expenditure side. We don't want a situation where expenditure is completely out of control, and I think that will also be very closely monitored.
Chantal, thank you so much for your time. That is Chantal Marks from FNB Wealth and Investment. And yesterday we were focusing on US CPI data, as we mentioned, coming in at 3.1% versus the forecast for 2.9%. But the focus now for the markets goes beyond the US CPI figures. We're going to be paying attention to what the Fed speakers are going to be saying, because we want to understand any kind of clues when it comes to Fed rates. However, it's going to be quite interesting as we have the Chicago Fed President Austin Goolsbee will be giving a speech, and whether he offers any clues given the figure that we got yesterday. And then tomorrow we'll have US retail sales that will give us an overall picture on the health of the US economy. We're going to take a quick break, and when we come back, we'll have more news for you, so stay tuned.